Morning. So for today's discussion, we will be having the ratio analysis. As what I've said in the previous video, we will be discussing the different types of ratio analysis and its corresponding implication to the financial health of an organization. Okay, so to begin with, let us identify first the different categories of ratio analysis. Now we have here first the liquidity ratio. Next is the solvency ratio, the profitability ratio, the efficiency ratio, and lastly, the market prospect ratio or the market value ratio. So let's have first the liquidity ratio. Now, liquidity ratio, it measures a company's ability to pay off its short-term debts as they become due using the company's current or quick asset. Now, liquidity ratios are an important class of financial metrics used to determine a debtor's ability to pay off current debt obligation without raising external capital. So here, in this category, we have three common types of liquidity ratio. First up, we have here the current ratio. It measures a company's ability to pay off its current liabilities, which means payable within 1 year, with its current assets, again, such as the cash, the accounts receivable, and inventories. Okay, so for the formula, we have here the current ratio is equal to the current asset divided by the current liabilities. Next, we have here the quick ratio. Now, in this ratio, it measures a company's ability to meet its short-term obligations with its most liquid asset. Most liquid asset, unlike the current ratio, it considers all current assets, while in the quick ratio, it only considers the most liquid asset that belongs in the current asset, and therefore it includes inventories. So basically, the difference between the quick ratio and the current ratio is that quick ratio doesn't um, include inventories in the computation, while current ratio includes inventories in its current asset. Now, for the quick ratio, it is also known as the acid test ratio. Now, for this, the formula of quick ratio is current asset less inventories divided by the current liabilities. Okay, so for the last type of liquidity ratio, we have here the net operating working capital. Now, the net operating working capital, it measures a company's operating liquidity, okay, by comparing its operating assets to its operating liabilities. Now, from the word operating, meaning to say we are considering here the current assets and the current liabilities. Now, for the formula we have here, now see, or the net operating working capital is equal to the operating current asset. Again, that's what I've said, operating current asset less the operating current liabilities. We have here the current ratio. So in this ratio, we will be having the balance sheet of the Leon Corp as an example. Okay, so again, the formula of current ratio, it is equal to the current asset, okay, divided by the total current liabilities. Okay, so we have it here. Next is we will going to compute the current ratio for year 2002 and 2001. Okay, so using the formula, the current ratio or the current asset for year 2002 is 1,926,802 divided by its current liabilities of 1,650,568. Now, in year 2001, its current asset is 1,124,000 divided by its current liabilities of 481,600. So in year 2002, we have the De Leon Corp has a current ratio of 1.17 and 2.33 in year 2001. Now, what does this imply? So this implies that De Leon Corp has 1.17 pesos and 2.33 pesos current asset for every peso of current liability. So meaning to say, the De Leon Corp has a capacity or capability of paying off its current debt through its current asset. Okay. Now, the decrease of the firm's current ratio was due to the increase in its financing activity for year 2002. So, as you can see here, the total current liabilities in 2002 has significantly increased from 481,600 to 1,650,568. We have here the quick ratio. Now, for the formula of quick ratio, we have here quick ratio is equal to current asset less inventories divided by its current liabilities. So again, we will be computing the quick ratio of the Leon Corp for year 2002 and year 2001. Now, for year 2002, the current asset here is 1,926,802 less the 1,287,360 inventories divided by 1,650,568 current liabilities. Now in year 2001, we have here 1,124,000 less 715,200 inventories divided by its current liabilities of 481,600. Now, in year 2002, we have a quick ratio of 0.39, while in year 2001, we have a quick ratio of 0.85. Okay, so this implies that the Leon Corp has less than 1 peso current asset for every peso of current liabilities. Meaning to say, it only, in year 2002, it only have a 0.39 current asset for every peso of current liability. So it can only pay off 0.39 for every peso of liability. Now, if you can observe, the quick ratio has a lesser figure than the current ratio, considering that the current ratio considers inventory in its computation, while quick ratio excludes inventory in its computation. Now, as you can observe in the De Leon Corp balance sheet, the total asset or the total current asset, the majority of it belongs to the inventory. Okay, that is for the both year. So that is the reason why there was a significant drop of its quick ratio from its current ratio. Now, there is also a significant decrease of the quick ratio from 2001 to 2002, mainly because there was a significant increase on its financing activity, which you can see in its total current liabilities. Okay, so from 481 here, it increased to 1,650,568. So now we have here the last type of the liquidity ratio, which is the net operating working capital. So for the formula, we have here the operating asset less the operating current liabilities. Now, okay. Now again, we will be computing its now C for the years 2002 and 2001. For 2002, now C is equal to the 1,926,802 operating current asset less the 1,013,760 operating current liabilities. Now, why is it only 1,013,760? Because the operating current liability excludes any current loans that are interest bearing liabilities. Okay, so basically notes payable is an interest bearing liability, so definitely it is excluded from the computation for the operating current liabilities. So again, operating current liabilities is the total current liabilities less the notes payable. Okay, so in year 2001, um, the total current asset here is 1,124,000 less its total operating current liabilities of 281,600. Now for 2002, we have the net operating working capital of 913,042, while in 2001, we have the net operating working capital of 842,400. So what does this mean? It implies that De Leon Corp has the capacity to pay off its working liabilities with only a portion of its working asset. Okay, so we have here the second category for the ratio analysis, and we have the solvency ratio. Now, the solvency ratio, it is a key metric used to measure an enterprise's ability to meet its debt obligation and is used often by prospective business lenders. The solvency ratio indicates whether a company's cash flow is sufficient to meet its short and long-term liabilities. Now, this kind of ratio is also called leverage ratios. This measures a company's ability to sustain operations indefinitely by comparing debt levels with equity assets and earnings. Now, in other words, this ratio identifies going concern issues and a firm's ability to pay its debt in the long term. Now, this ratio differs from the liquidity ratio as it focuses more on the long-term sustainability of the company. So, for the formula, we have here the solvency ratio is equal to the net income plus non-cash expenses divided by its total liabilities. Okay, so for the solvency ratio, we also have three types of solvency ratio. First off, we have the debt to equity ratio. The formula for it is that total liabilities divided by its total owner's equity. So here we are comparing the level of liability to its equity. Next is the total debt to total asset ratio. The formula for this is total liabilities divided by its total asset. Okay. Next is the interest coverage ratio, which is equal to the EBIT or the earnings before interest and taxes divided by its interest expenses. So we have here the solvency ratio. Now, again, the formula for the solvency ratio is equal to net income, okay, net income plus the non-cash expense. So basically, it is the depreciation and amortization expense divided by its total liabilities. Okay. Now again, we will be computing the year 2002 and 2001 solvency ratio. First off, we have here the solvency ratio for 2002. For the net income, we have a negative 160,176 plus the non-cash expense or the depreciation of 116,960 divided by its total liabilities of 2,374,000 pesos. In year 2001, the net income is 87,960 plus its depreciation of 18,900 divided by its total liabilities of 805,032. Okay, so that is the computation. And then our solvency ratio for year 2002 is a negative 2% or negative 0.2. While in 2001, we have here a 13.27% or 0.1327. Now, what does this mean? This implies that De Leon Corp has a negative 2%. Okay, if you can see here, it's a negative 2% solvency ratio in the current year. Now, it means or it is significantly lower than the 13.27% of year 2001. Now, what does this negative 2% means here? It definitely means that De Leon Corp has no capacity of paying its total liabilities from its operating income. Now, this means that the firm has a greater probability that it will default. Okay, default meaning to say the act of not paying off its debt, or again, has no capacity of paying its debt obligations. We have the second type of solvency ratio, the debt to equity ratio. Now, for this example, we have here the formula for the debt to equity ratio, the total liabilities, okay, divided by its total owner's equity. Okay. Now again, we will be computing the debt to equity ratio of the Leon Corps for 2 years, the 2002 and 2001. Now for the 2002, the total liabilities of 2,374,000 divided by its 492,592 total owner's equity. And for year 2001, we have the 805,032 total liabilities divided by its 663,768 total equity. Now, in year 2002, the Leon Corp has a debt to equity ratio of 4.82, while in year 2001, the Leon Corp has a debt to equity ratio of 1.21. Now, what does this figure implies? Um, for year 2002, it has a debt to equity of 4.82, in which it implies that the De Leon Corp is very leveraged or highly leveraged, okay? It has a 4.82 here. And this means that it is very risky investment for investors who are planning to invest in the said firm. So basically, the higher or the greater the debt to equity ratio, uh, the risky the investment is. And the lower the debt to equity ratio, the lesser the risk that entails with the investment. Here we have the third type of solvency ratio, the total debt to total asset ratio. Okay, so in this formula, we have the total liabilities divided by its total asset. Now, in this solvency ratio, we are assessing or examining the level of total liability against its total asset. Okay, so let's start to compute the total debt to total asset ratio of the Leon Corp for year 2002 and 2001. Okay, for 2002, we have here the total liabilities of 2,374,000 and a total asset of 2,866,592. In 2001, we have a total liability of 805,032 and a total asset of 1,468,800. Now, for the total debt to total asset ratio, for year 2002, we have here 0.83, and in 2001, we have here 0.55. Now, what does this mean? It means that the De Leon Corp has a 83%, okay, here, 83% or 0.83 of the company's asset, okay, of the company's asset that is funded via debt, okay, or via its total liabilities, okay. So the increase in the total debt to total asset ratio here, okay, if you can see, there is an increase from 0.55 to 83, 0.83 in 2002. This is mainly due to the expansion activity of the company. Here, the last type of solvency ratio, which is the interest coverage ratio. Okay, now for the formula, again, the interest coverage ratio is equal to the EBIT, or the earnings before interest and taxes, divided by its, okay, here, divided by its interest expense. Okay, now again, we will be computing the interest coverage ratio for 2002 and 2001. Okay, here for 2002, the EBIT here is negative 130,948 divided by its interest expense of 136,012, while in 2001 it has an EBIT of 190,428 and an interest expense of 43,828. Now, the interest coverage ratio, as a result, for 2002, it has a negative 0.96, while in 2001, it has 4.34. Now, this means that De Leon Corp has a negative 96, okay, negative 96 here, interest coverage ratio for 2002, or basically zero times, okay? Meaning to say the firm has no capacity of paying its interest expense, no capacity, okay, here, no capacity of paying its interest expense using its operating profit. But in year 2001, here, the Leon Corp can pay its interests 4.34 times with its operating profit. Now we have here the profitability ratio, the third category for our ratio analysis. Okay, so profitability ratio, this measures a company's ability to generate earnings relative to its revenue, operating costs, balance sheet assets, or shareholders' equity. Now, basically, the group of ratios that shows the combined effect of liquidity, asset management, and debt on operating results. Now, this type of ratio is also widely used for comparing competitors within the same industry. As what I have said a while ago, um, it is widely used for industry analysis now. So, the higher the value relative to its competitors' ratio or relative to the same ratio from a previous period indicates that the company is doing well. So, the higher the value, the better. Okay, now let's examine the different types of profitability ratio. First off, we have here the operating margin. Now, the operating margin, it measures how much profit a company makes on a peso of sales. So basically, operating margin is equal to the EBIT, or again, the earnings before income and taxes divided by its total sales. Next, we have here the profit margin. Now, the profit margin, it measures a company's profitability at various cost level, including gross margin and operating margin, pre-tax margin, and the net profit margin. Now, here we are referring to the net profit margin, which in which the formula is net income divided by its total sales. Now, the difference between the profit margin or the net profit margin and the operating margin is that operating margin focuses only on the operating profit, while the net profit margin focuses on the net income already. Next, we have here the return on asset. Now, the return on asset, it assess the relative or is assessed relative to cost and expenses and analyzed in comparison to asset. Okay, in comparison to asset, to see how effective a company is deploying asset to generate sales and profits. Now, here the formula for the ROA is net income divided by the total asset. Okay. Next, we have here the basic earning power, or the BEP, which measures or it calculates the earning power of a business before the effect of business income taxes and its financial leverage. Now, again, we are looking on the income before income taxes, okay? Now, the formula here again is the EBIT, or the operating profit, divided by its total asset. Lastly, we have the return on equity. Now, the return on equity, it measures a company's ability to earn a return on its equity investments. So basically, the difference between the return on asset and the return on equity is that the return on asset compares its or compare its level of net income to its total asset, while the return on equity compare its level of net income to the total equity. So now let's have the first profitability ratio, which is the operating margin. Okay, so the formula for the operating margin is EBIT, or the earnings before interest and tax, divided by its total sales. Now for this, in year 2002, De Leon Corp has a negative EBIT of negative 130,948 divided by its total sales of 6,034,000. While in 2001, it has an EBIT of 190,428 divided by its total sales of 3,432,000. Okay, so in year 2002, it has an operating margin of negative 0.022 or negative 2.2%, while in 2001, it has an operating margin of 0.55 or 5.5%. Now, this implies that the Leon Corp has a negative 2.2 of operating margin in 2001. Okay, so which means that every peso or each peso earned in sales or revenue brings negative 2.2 cents in operating profit. Okay, but in 2001, each peso earned in revenue brings 5.5 cents in operating profit. The second type of profitability ratio, we have here the profit margin or the net profit margin. Okay, so in this formula, it is equal to the net income divided by its net income divided by its total sales. Okay, now let's compute the net profit margin of the Leon Corp for 2002 and 2001. Now for 2002, the profit margin is equal to its negative 160,176 net income, or shall I say net loss, divided by the total sales of 6,034,000. And then in 2001, it has a total net income of 87,960 divided by the total sales of 3,432. So, the profit margin for year 2002 for the Leon Corp is negative 0.026 or negative 2.6%, while in 2001 it has a 2.56% profit margin. Now, this implies that the Leon Corp has a negative 2.6% of profit margin in the year 2002, which means that each peso earned in sales or revenue brings negative 2.6 cents in the net income. Okay, so basically this negative translates into a negative 2.6, and it translates into a net loss for the year 2002. But in 2001, each peso earned in revenue brings 2.56 cents in the net income. So basically, it represents the profit margin represents what percentage of sales has turned into profit. Type of profitability ratio, we have here the return on asset. Okay, so the formula for the return on asset is equal to the net income divided by its total asset. Okay, now for year 2002, the Leon Corp has a negative 160,176 net income divided by its total asset of 2,866,592. In year 2001, De Leon Corp has a net income of 87,960 and a total asset of 1,468,800. So in 2002, it has a ROA of negative 5.59% and
5.99% for 2001. Now, this implies that De Leon Corp has a negative 5.59% return on asset in the current year, which is significantly lower than the 5.99% in year 2001. So this means that the firm has been using its resources or its asset efficiently in converting into profit in year 2001 compared to the current year. So for the fourth type of profitability ratio, we have here the basic earning power. Now for the formula, we have here the EBIT or the operating profit divided by its total asset. Now for year 2 of the Leon Corp, we have the BEP is equal to negative 130,948, which is the EBIT, and divided by its total assets of 2,866,592. For 2001, the Leon Corp has a 190,428 EBIT and total asset of 1,468,800. So in 2002, it has a negative 4.57% basic earning power, while in 2001, it has a 12.96% basic earning power. Now, this implies that Leon Corp has a negative 4.57 basic earning power in the current year, which is significantly lower than the 12.6, okay, 12.6 in year 2001. Now, this means that the firm has been using its resources or asset efficiently in converting into operating profit in 2001 compared to the current year. Now, the difference between the ROA or the return on asset and the basic earning power is that we are assessing, in ROA, we are assessing the efficiency of the company in using its asset in converting to the net income. While here in the basic earning power, we are assessing the efficiency of a company in converting its resources into operating profit alone. Okay, so we have here the last type of profitability ratio, which is the return on equity. Now, for the formula, we have here net income divided by the total equity. Now, for year 2002, the ROE for De Leon Corp is computed as negative 160,176 for the net income divided by the total equity of 492,592. While in 2001, we have here an 87,960 net income divided by the total equity of 663,768, which results to a negative 32.52% ROE for 2002 and 13.25% return on equity for 2001. Now, this implies that the negative 32.52% of De Leon Corp's return on equity in the current year, which is significantly lower than the 13.25% in year 2001. And then this means that the firm has been again using or efficiently making profit through its equity in the year 2001 than the current year. So from all the five profitability ratio, it shows that in 2001, De Leon Corp has been doing great, yet in 2002, there was a downfall on the operations, especially on the profit making of the company. Now, we have here the fourth category for the ratio analysis, and that is efficiency ratio. Now, efficiency ratio, this is typically used to analyze how well a company uses its assets and liabilities internally. This is also known as activity ratio, which are used by analysts to measure the performance of a company's short-term or current performance. Now, all these ratios use numbers in a company's current assets or current liability, quantifying the operations of the business. Now, we have here several types of efficiency ratio. First off is the accounts receivable turnover. This is basically the credit sales divided by its average accounts receivable. The inventory turnover, that is the cost of goods sold divided by average inventory rather. Fixed asset turnover, that is revenue divided by total fixed asset, and then the total asset turnover, which is revenue divided by the total asset.
Okay, so first we're going to have the first type of efficiency ratio, that is account receivable turnover. Okay, so the formula for that is credit sales divided by its average accounts receivable. Now here in our example, the De Leon Corp, um, the given is only the total sales, so we will be assuming here that the 40% of the total sales are made on credit. Okay, now so you're going to compute the accounts receivable turnover for the year 2002. So here we will first get the 40% of the 6,034,000 total sales in 2002, and then the average accounts receivable, which is the end year or the ending balance for 2002 plus the beginning balance for 2002. So here the ending balance for 2002, it is 632,160 plus the beginning balance for 2002, that is the ending balance of 2001. So that is 351,200 divided by 2. Okay? Next, okay, so we got the credit sales and the average accounts receivable, that is 2,413,600 divided by 491,680. So we got here the accounts receivable turnover of 4.91 or 5 times. Okay, so what does it imply? It implies that the De Leon Corp's accounts receivable turned over 4.91 or 5 times, almost 5 times during the past year. So this means that the average accounts receivable was collected in 73 days. Now, how do we get the 73 days here? It is 365. That is the total number of days in a year divided by the accounts receivable turnover of 5 times. So we have here the average 73 days in which the Leon Corps could or would collect its accounts receivable from its client or customers. Okay, so here we have the second type of efficiency ratio, that is inventory turnover. Okay, so the formula for this ratio is cost of goods sold divided by the average inventory. Now here we will also be going to compute the year 2002. Now the cost of goods sold, that is for 2002, we have here the 5,528,000 divided by the average inventory. So same with average accounts receivable that I discussed a while ago. So we will be having 1,287,360. That is the balance of the inventory for year 2002 at the end. And then 715,200. That is the beginning balance of the inventory account for 2002, which is also the ending balance of the year 2001. So divide that by 2, so we could get the 1,001,280 average inventory. Okay, so after that, we can now get the inventory turnover of 5.52 or 6 times. Now, what does it imply? Same with the accounts receivable turnover. The inventory turnover here it implies that De Leon Corp's inventory turned over 5.52 or almost 6 times during the past year. So which means to say that inventory is on hand for 61 days on an average. So again, how did we get the 61 days? That is 365 divided by 6. So the implication here is that um, the Leon Corp is holding its inventory for an average of 61 days. Okay, now let's move on to the third type of efficiency ratio, that is the fixed asset turnover. Now, the formula for the fixed asset turnover is revenue divided by the average fixed asset. Okay, here the revenue or the total sales divided by its average fixed asset. Okay, so for year 2002, we have here the total sales or the total revenue of 6,034,000 divided by its average fixed asset. That is the same process in computing with the average accounts receivable and average inventory. So we have here the ending balance for 2002, which is the 939,790 plus the beginning balance for 2002, which is also the same as the ending balance of 2001, that is 344,800 divided by 2. So we get here an average fixed asset of 642,295. So the total fixed asset turnover here is 9.39, meaning to say that the Leon Corp's fixed asset turnover is 9.39, which means that every peso invested in fixed asset, there is a return of 9.39 pesos that is being earned by the company. So let's have the last type of efficiency ratio, that is the total asset turnover. Now, the formula for that is revenue divided by its average total assets. So, just similar with the total fixed asset or the fixed asset turnover, it's just that it is divided, or the divisor is the average total asset. Okay, so for year 2002, um, we will be again having the revenue, that is 6,034,000, and then divided by the average total asset, that is 2,866,592 plus the beginning balance for 2002, that is 1,468,800 divided by 2. So we could get an average total asset of 2,167,696. To get the total asset turnover of 2.78, which means that the Leon Corp's total asset turnover is 2.78, which means that every peso in the asset, the firm generated 2.78 pesos in sales. Okay, so we have here the last category for our ratio analysis, that is the market value ratio. Now, the market value ratio is the ratios that relates the firm's stock price to its earnings and book value per share. Now, these ratios are employed by current and potential investors to determine whether a company's share are overpriced or underpriced. Okay. Now here, we have first the price earning ratio, which is the ratio for valuing a company that measures its current share price relative to its per share earnings, or the EPS, or the earnings per share. Now the formula for this is that market value per share divided by the earnings per share. We have also here the market to book value, which measures the market value of a company relative to its book or accounting value. Now, the ratio for this is the equation rather, is market price per share divided by its book value per share. First, we're going to have the first type of market value ratio, that is the price earning ratio. Okay, now the price earning ratio again, it is the price that an investor is paying for every peso of a company's earning or profit. Now here, the formula for the price earning ratio is the price per share divided by the earnings per share. Now, for this ratio, we will be having, or we will be computing the 2 years ratio for De Leon Corp. Okay. Now, first is we will first compute the earnings per share, that is the net income divided by its total number of shares outstanding. Here, in 2002, we have a negative 160,176 net loss, and then divided it by 100,000 total shares or number of shares. And in 2001, we have 87,960 net income divided by 100,000 number of shares. So here in 2002, we have an EPS or earnings per share of negative 1.6, while in 2001, we have an EPS of 0.8796. Now, to get the PE ratio, again, we will be having the price per share, that is in 2002, we have 2.25 divided by the negative 1.6 EPS, that in 2001, we have 8.5 share per price per share, and then 0.8796 earnings per share. So in 2002, we have a P/E ratio of negative 1.41 times. Then in 2001, we have a P/E ratio of 9.66 times. Okay. Now, what does this say? Here, due to the net loss of De Leon Corp's or De Leon Corporation for the year 2002, it has a negative P ratio, which means that the company is losing money. Now, thus, the negative P ratio will not be reported in the financial statement. Rather, it would be, or the managers would indicate their NA, meaning to say that the PE ratio is not applicable. Okay, so we have here the last type of market value ratio, that is the market to book ratio. Now, in this example, we have the formula of price per share divided by the book value per share. Now here, we will be computing first the book value per share. That is the total equity divided by the total number of shares. Now here in 2002, the total equity is 492,595 divided by 100,000 total number of shares. In 2001, we have 663,768 divided by 100,000 total number of shares. For 2002, we have here the book value per share of 49.26, and in 2001, the book value per share is 66.38. Now, we will now get the market to book value ratio. So again, we have here the price per share, that is 2.25 divided by its book value per share, which is 49.26 for 2002. And then for 2001, we have here the share price of 8.50 divided by its book value per share of 66.38. So in 2002, we have a book or market to book value rather, ratio of 0.046, and then in year 2001 we have the market to book value of 0.13 times. Now, what does this says, or how does the investor read these figures? Now for years 2001 and 2002, the company or the firm's market to book ratio is lower than 1. Okay, so basically especially in 2002, that it has significantly decreased from 0.13 to 0.046, which indicates that the stock is really undervalued, which means to say that the investors could see this as a bad or risky investment. Okay, so we have here the last type of ratio analysis, that is the DuPont equation. Now, the DuPont equation, that it is a framework for analyzing a fundamental performance popularized by DuPont Corporation. Now, the DuPont analysis, it is a useful technique used to decompose the different drivers of return on equity. Okay, so basically, the DuPont equation is um, a, an alternate equation for the ROE. So there are three major financial metrics that drive return on equity. So here, the operating efficiency, the asset use efficiency, and the financial leverage. Now, using its DuPont equation, or the DuPont equation, or the ROE equation, the return on asset here measures the operating efficiency and the asset use efficiency, while the equity multiplier measures the financial leverage of a company. Now, here in the example, okay, so we will be computing the DuPont equation, or the ROE, for year 2002. So for the equity multiplier, we will first compute the equity multiplier, that is total asset divided by its total equity. So for year 2002, the total asset is 2,866,592 divided by the 492,592, that is equal to 5.82 equity multipliers. So now let's get the ROE using the DuPont equation. Now the ROE here, again, that is return on asset. Now, based from the previous slides, we have a return on asset of negative 5.59% multiplied by the equity multiplier of 5.82, that in that we can get a negative 0.32533. And if you're going to check this result, from the previous slide that we computed with the return on equity, we will be having almost the same figure with a slight difference in the decimal. Okay, so the analysis here is that by having a negative DuPont ratio, or negative ROE, it means that the company is really highly risky. Okay, highly risky to those investors who are planning to invest. Okay, by looking at its equity multiplier, the company is really highly leveraged, and then the company is not very efficient in using its asset to generate more profit. Okay, because it has a negative 5.59% of return on asset. Okay, so it's a wrap. We have just finished the ratio analysis, and if you want to explore more about ratio analysis, you can see more of it in the internet. So those ratios that I have just discussed in the presentation are just some of the common ratios that an investors or managers uses in analyzing certain financial statements. So I hope at this point in time you have now an idea on how important it is to read and analyze financial statement, as you are going to be a financial analyst soon. So that's all. Thank you and keep safe.